Right now, the Nikkei225 is sitting at 64,996, teasing the 65,000 number that every retail trader is watching. But here is the problem. The price is painting a textbook trap, and most people will be on the wrong side of it. There is one danger zone and one hidden opportunity today. I will show you both. Stay until the end because I am giving out 3 exact entry and exit levels you can use immediately, with stops and risk-reward ratios calculated down to the point. Let me give you the instant market verdict. The session bias is a fade of the intraday breakout, meaning we are looking for a rejection of the 65,000 magnet and a rotation back into the strong daily support band. The overall trend remains a roaring strong buy on the weekly and monthly timeframes, but the 1-hour chart has turned neutral, and that exhaustion tells me the steam is running out in the very short term. Write this number down. The invalidation level for the entire bullish structure today is 64,120. If we close any 4-hour candle below 64,120, the pullback accelerates straight into 62,918 and the buy the dip narrative fractures. Above 65,967, this entire cautious thesis is wrong and we are going full breakout mode. So one level below kills the bulls, one level above kills the bears. That is your range. Now let us walk through the technicals, and I want you to visualize the chart as I speak. Pull up your weekly Nikkei225. The weekly trend is a strong buy. Price is miles above every major moving average. The 50-week moving average is around 59,831, the 100-week sits at 57,121, and the 200-week is all the way down at 53,266. This is what a structural bull market looks like. No argument. The MACD on the weekly is still printing green histogram bars, and the RSI at 66 is not overbought yet. There is room. That is why, from a macro perspective, any dip into the 64,000 region is a gift. But now flip down to the daily chart, and you see the first crack in the armor. The daily trend is also a strong buy, but price has been grinding sideways for the last 2 sessions. We have the 5-day moving average at 63,930 acting as the immediate dynamic support. The 10-day is 63,136. The 20-day is 62,102. These are your stepping stones. As long as the Nikkei holds above the 5-day, the path of least resistance is up. The 200-day moving average is way down near 53,266, so the long-term moving averages are not even in play. But what I am watching on the daily is the MACD histogram starting to flatten. The MACD line is at 1,460 and change, still positive, but the momentum is decelerating. This is the classic setup where the trend is up, but the entry is terrible if you chase the breakout above 65,000. Drop to the 4-hour and 60-minute charts, and the neutral 1-hour trend jumps out. On the 60-minute, price is oscillating around 65,000 with no conviction. The moving averages on the 60-minute are clustered. We have the MA20 at 64,880, the MA60 at 64,650, and the MA200 at 64,200. See the compression? That is a volatility coil. When moving averages compress like this, the expansion move is usually violent. The MACD on the 60-minute has rolled over with a small bearish crossover, and RSI is drifting lower from 66 towards 60. This tells me the immediate pressure is to the downside, targeting the 64,650 zone first, then the 200-hour at 64,200. That 64,200 area aligns perfectly with the daily 5-day moving average and the lower bound of the value area. It is a high probability reload zone for longs. Here is what most traders miss. Look at the key resistance levels I gave you. 65,967 and 66,611. Those are not random. 65,967 is the previous swing high from last week, a liquidity pool sitting just above the round number. 66,611 is the upper boundary of the monthly ascending channel. If we break 65,967 with a 4-hour close, the stops above get hunted, and we likely stretch to 66,611 in a single expansion leg. On the support side, 64,120 is the big one. That is the low of the consolidation zone from 4 days ago and corresponds to the 200-hour moving average I just mentioned. Below that, 62,918 is the structure support, the floor from 2 weeks ago, right near the daily 20-day moving average. Know these numbers, because every single trade idea I am about to give you hangs on them. Now we have to weave in the cross-asset narrative, because the Nikkei does not trade in a vacuum. The biggest invisible hand right now is US dollar to Japanese yen and the Bank of Japan. Intervention ghost. The Nikkei225 and the yen are joined at the hip with a tight negative correlation. When dollar-yen rallies, the yen weakens, Japanese exporters become more competitive, and the Nikkei surges. When dollar-yen falls, the Nikkei typically gets a nosebleed. Yesterday, Japan stocks closed lower, Nikkei225 down 0.29%, and that tiny drop came as US dollar to Japanese yen stalled just below 140. The market is terrified of pushing dollar-yen higher because the Ministry of Finance has drawn a line in the sand. Every yen trader is asking, where is the intervention trigger? If the BOJ steps in and drives dollar-yen down even one big figure aggressively, the Nikkei will catch a correlated flush. That is the phantom risk sitting on top of 65,000. On the flip side, if the intervention fear fades and US yields keep grinding up, dollar-yen pops, and the Nikkei ignites. So the true catalyst for the next 1,000-point move in the Nikkei is the yen, not domestic Japan news. The 1 to 2 week directional lean is bullish, but only if we get a clean pullback that resets the hourly momentum. The event that would invalidate this bullish lean is a weekly close below 62,918. If that happens, the buy the dip crowd gets punished, and we could test the 60,000 psychological level. But as long as US dollar to Japanese yen holds above the 138 level and the BOJ stands pat on yield curve control, the path of least resistance for Nikkei remains higher. The fundamentals of the Japanese equity market are buoyant. Corporate buybacks are at records, and the Tokyo Stock Exchange reform is forcing companies to improve valuations. So do not get bearish just because the hourly chart is neutral. Most people will skip this next part, but this is where money is made. Keep watching. I am going to give you 3 trade setups with exact triggers, stops, and risk-reward logic. Write them down. Strategy 1. The sniper. Conservative. This is for traders who want high probability and are willing to wait. The setup is a pullback buy into the 200-hour moving average dynamic support zone. The exact trigger is a 4-hour candle close above 64,300. That level sits right on top of the 200-hour MA and the daily 5-day MA, providing a double confluence. I want to see a 4-hour close above that zone, confirming the rejection of the support. The stop loss goes at 64,080, just below the 64,120 critical invalidation level. So we are risking about 220 points from the trigger close. Target 1 is 65,000, the round number liquidity magnet, giving a risk-reward of roughly 1 to 3. Target 2 is 65,900, just below the 65,967 resistance, taking risk-reward to over 1 to 7. What voids this sniper setup? If the price just slices through 64,120 on a 4-hour close without a bounce, you step aside. No hero entries. Patience is the edge. Strategy 2. The active trader, standard. This is for those who want to engage the current range with a mean reversion play off the intraday extremes. The entry condition is a failed break above 65,000 that reverses back down. Specifically, wait for the 60-minute candle to print a clear rejection wick above 65,000 and then close back below 64,950. That is your trigger. The entry is at the open of the next candle, around 64,950. Stop loss is placed at 65,220, just above the wick high, risking 270 points. Why there? Because if we accept above 65,200, the breakout is probably real. Target 1 is 64,650, which is the 4-hour MA60, giving a 1-to-1 risk-reward. Target 2 is 64,200, the 200-hour MA, yielding 1 to 2.7. Here is the active trader rule. Once target 1 is hit, move the stop to break even. That is non-negotiable. This setup exploits the liquidity trap, catching the breakout chasers wrong-footed. Let me ask you a question. Let us see how aligned we are. Type your Nikkei225 range for tomorrow in the comments now. I am reading them. Give me your high and low. I want to see who is thinking like an institutional trader. Strategy 3. The Aggressor, high risk. This is a counter-trend momentum fade that relies on extreme short-term overbought readings. Only for those who know how to lose small and manage risk aggressively. If the Nikkei spikes in the first hour of the Tokyo session and tags 65,700 on the 5-minute chart, that is your trigger. You need to see the RSI on the 5-minute shoot above 80, and then quickly drop below 70. That signals a blow-off top. Enter short at 65,680 with a tight stop at 65,780, risking just 100 points. This is a scalp. Target 1 is 65,400. The swift mean reversion, risk-reward 1 to 2.8. Target 2 is 65,100. The prior consolidation high. Do not hold this through the cash equity close. The aggressor trade works only because the 65,967 resistance is breathing down the neck of any intraday rally. The market is not yet ready to smash through that level without a major catalyst. But remember, if the breakout happens with volume and we take out 65,967, this short is crushed instantly. You must be fast. Here is the risk management pulse. Never risk more than 1 to 2% per trade. No positions through high-impact news like the Tokyo fix or BOJ announcements. Stops are non-negotiable. If 64,120 breaks, accept the loss and move on to TO. Close the loop. Let me summarize the single most critical level for the next session. 64,120. That is the line. A daily close below that, and the bullish structure cracks wide open. Above that, every dip is a reload opportunity, and the breakout towards 66,611 stays alive. Tomorrow we focus on the Tokyo Open reaction to US dollar to Japanese yen and any fresh BOJ jawboning. If dollar-yen makes a sudden move, the Nikkei will front-run it in seconds. You need to be ready. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Check the end screen, because the correlation fracture we are seeing there is the most important macro signal of the month. Smash like if this analysis gave you a clear plan for the Nikkei. Subscribe and hit the bell for daily coverage. I will see you in the next one.